Welcome to the deep dive. Today we are jumping into the really dynamic world of renewable energy. We're focusing specifically on Waaree Energies Ltd, WL. Our sources are hot off the press regulatory filings, recent press releases, and their investor presentations covering Q2 in the first half of FY26. That period just ended September 30th, 2025. And our mission here isn't just, well, reading out numbers. We want to figure out what's really driving this performance. They're calling it their best ever quarter, but maybe more importantly, we need to break down their huge, frankly, quite audacious strategy. They seem to be shifting from just being a solar module maker to a fully integrated energy solutions provider.
Yeah, it's a really critical moment to understand, I think, because this isn't just about reporting results. It's watching a major strategic shift in real time. I mean, they're already India's top renewable energy company, right? With something like 18.7 gigawatts of installed module capacity. But the conversation now, it's less about maintaining that lead and much more about the massive, massive capital spending they're planning to really dominate the future market. That's what we need to unpack for you.
Okay, so let's start with the foundation for all this ambition, financials. And they really are, well, pretty astonishing for Q2 FY26. Total income. It crossed 6,200 crore. That's almost a 70% jump compared to the same quarter last year.
Huge top-line growth, but, the profit figures are maybe even more eye-catching. Profit after tax, the PAT, it surged 134% year-on-year. So this isn't just about selling more, it's about selling much more profitably. Look at the EBITDA that grew 155% year-on-year. Incredible leverage.
Right. And with that kind of profit jump, you always wonder about the margins. Yeah, are they sustainable?
Well, they look very healthy right now. The EBITDA margin expanded significantly. It hit 25.17%.
Wow.
Yeah, that's up from 16.76% in Q2 last year. That kind of jump, it points towards, a really good product mix, maybe better cost absorption because of the scale, and definitely strong pricing power.
And what about how they're using their capital? I mean, in this kind of heavy industry sector, efficiency matters hugely.
It absolutely does. And the numbers here are impressive too. High return ratios, which is exactly what you want to see before a big investment phase. Their ROCE, return on capital employed, hit 41.8%. And ROE, return on equity, was 34.8%.
Oh, these are strong numbers.
They really are. It shows they handle capital very efficiently, which, frankly, gives them credibility for this enormous CapEx plan they've got. Oh, and they also approved an interim dividend, 2 rupees per share, a signal of confidence.
Okay, so strong results, good returns. But what about the outlook? Markets always look forward. Did they stick to their guidance?
They did. They reaffirmed that really ambitious FY26 EBITDA guidance. They're aiming for between 5,500 crore and 6,000 crore for the full year.
That's projecting, well, continued massive growth for the second half.
It is. It sets a very high bar for execution, doesn't it? Means the core business has to keep firing on all cylinders while they're also managing this big strategic pivot.
And it seems the core business is firing. They hit a record for quarterly module production in Q2 2.6 GW. That's leveraging their current, 18.7 GW module capacity. And critically, that big 5.4 GW solar cell facility, India's largest, is now fully up and running.
Exactly. And having that cell capacity online is key. It feeds into that higher margin domestic content segment we should touch on later. But yeah, that operational strength is why they can project such strong visibility. Look at the order book.
Right, the order book. How big is it?
It's massive, around 24 GW currently. And the value they put on that is roughly 47,000 crore.
47,000 crore. Okay, that's a significant backlog. Provides a nice cushion, I suppose.
It absolutely does. It underpins their ability to potentially hit that aggressive guidance we just talked about.
And where are these orders coming from? Is it mostly India, or is the global demand driving it?
It seems like a pretty healthy mix, actually, which is good, helps de-risk things. The presentation suggests roughly 60% is for overseas markets, 40% domestic, although one slide mentioned slightly different revenue mix numbers for Q2 itself, more like 53% domestic, 47% overseas. So the mix can shift.
Okay, so diversified demand.
Yeah. And maybe the most telling number is the future pipeline. They're citing an order pipeline of over 100 GW. That speaks volumes about the long-term confidence in solar globally and their position in it.
All right, let's shift gears then to the really big story. This pivot strategy. The investment behind it is just staggering. They're talking about an overall planned capital expenditure, CapEx, of over 25,000 crore. 25,000 crore.
It's an enormous figure. It's like building a whole new company alongside the existing one over just a few years.
And didn't they just add more to that pile?
They did, yeah. Just recently, October 1st, the board approved an additional capex, roughly 8,175 crore more.
Wow.
And this extra amount is specifically earmarked for these adjacencies, the new business lines. So it really confirms this isn't just about making more solar panels. It's about becoming a comprehensive energy solutions provider.
But, I mean, can they realistically fund that kind of money, 25,000 crore plus, while keeping those return ratios high, without taking on crippling debt or diluting shareholders massively? That feels like the core risk here.
It is. It's absolutely the defining challenge, execution and funding. But look where the money's going first. The biggest piece of that new funding, around 8,000 crore, is for battery energy storage systems.
Yes.
BE.
Islayas. Okay, that makes sense. Storage is critical for renewables.
Exactly. It's the key to stabilizing the grid with intermittent sources like solar and wind. And they're not just dipping a toe in, they're scaling capacity massively. From 3.5 gigawatt-hour currently, aiming for 20 gigawatt-hours. That's huge.
What's the timeline?
Phase 1, the first 3.5 GWh, they're targeting by FY27. The rest, so the bulk of it, by FY28. Ambitious.
What else are they betting on with this new capex?
Well, green hydrogen's another big one. They're increasing electrolyzer capacity from 300 milliW up to 1 GW. That's targeted for FY27.
Okay.
Though the capex for that is much smaller, about 125 crore. And they're also boosting their inverter capacity slightly from 3 GW to 4 GW. So it's BES, hydrogen inverters, all key pieces for modernizing the grid.
And it's not just building new factories, is it? They've been buying companies too.
Right. They're using acquisitions to speed things up. Buying Meyer Burger's U.S. assets for $18.5 million gives them an instant manufacturing footprint in the States. And taking controlling stakes in Kotzon's transformers and Racemosa energy meters, that clearly signals they want to manage the whole power infrastructure piece, not just generate the power.
So moving into the EPC space more heavily. Engineering, procurement, construction.
Seems like it. It positions them to offer the whole package for a utility project, from the solar farm itself right through to the grid connection hardware. That's a much higher value proposition than just selling modules.
And meanwhile, back in the core solar business, they're still expanding everything.
Oh, yeah. Full vertical integration. Module capacity heading towards nearly 27 GW. Cell capacity targeted over 15 GW by FY27. And crucially, that upstream piece, ingots and wafers, they're aiming for 10 GW of that by FY27 too, locking down the entire supply chain from start to finish.
Okay, so this huge expansion, this diversification, it makes more sense when you look at the demand forecasts and the policy environment, right?
Absolutely. You have to ask why they're doing this now. Well, first, India's own solar target is set to more than double, from about 127 GW now to 280 GW by 2030. That's massive domestic pull. And policies are helping. Things like the GST cut on components, making things 3–4% cheaper, plus big government spending on schemes like PM Surya Ghar for rooftop solar.
And then there's the global picture, particularly the U.S.
Definitely. The U.S. market is projected to hit maybe 500 GW of solar by 2030. And that's massively boosted by the Inflation Reduction Act, the IRA. Those 45X tax credits for domestic manufacturing are a huge incentive.
Which explains their Meyer Burger acquisition and wanting a U.S. footprint?
Precisely. But there's another demand driver, maybe the critical one underpinning the BESS and even the green hydrogen push: data centers.
Ah, right. The power consumption is enormous.
It's staggering. Just in the U.S., data center electricity demand is forecast to explode, from around 33 GW now to potentially 176 GW by 2035.
176 gigawatts.
Yeah.
Just for data centers.
Just for data centers. And these tech companies have sustainability goals. They need clean, reliable power. That means solar paired with BUS becomes almost non-negotiable.
And storage demand generally is booming.
Globally, yes. Projections show storage additions growing maybe fivefold by 2030. India itself is targeting something like 236 GWh of cumulative BES capacity by 2032. The market is enormous.
So connecting this back for you, the listener, why does this matter? Well, India's push for a Manor Bharat, self-reliance, combined with global trends towards, let's say, protecting domestic manufacturing. It makes this vertical integration almost essential for survival, let alone growth.
Exactly. Think about the ALMM, the approved list of models and manufacturers. That rule is coming for ingots and wafers by June 2028. If you want to sell into big government or PSU projects in India after that, you must control that whole supply chain ingot, wafer, cell module. It has to be domestically sourced.
So that huge euro 25,000 crore capex, it's not just a strategic bet, it's also about meeting future regulatory requirements to access a huge chunk of the domestic market.
Pretty much, yeah. It locks in their access.
Okay, let's dig into a few finer points that came up in the materials, things you might miss on a quick read, like how they accounted for those U.S. IRA tax credits.
Ah, yes, that was interesting. They recognized about 162 crore, which they said was 90% of the available credit, as other operating income.
Right, calling it operating income is significant, isn't it? Rather than, say, a one-off gain.
It is. It suggests management sees these IRA credits as a recurring operational part of their U.S. business model going forward, reinforces that commitment to U.S. manufacturing we talked about.
And back in India, you mentioned the margin advantage for domestic content.
Yes, the DCR segment domestic content requirement. This uses India-made cells, which they now produce at scale. And the key point is this DCR segment typically commands higher margins. They mentioned 300 to 350 basis points higher than modules using imported cells.
So maybe 3 to 3.5% higher margin.
Exactly. And that little detail helps explain quite a bit of that big overall margin expansion we saw earlier. Shifting more volume to DCR boosts profitability.
Okay, makes sense. But, operating globally, especially in the U.S. market, comes with risks. Did they mention the EAPA investigation?
They did acknowledge it, yes. There's an ongoing investigation by U.S. Customs, the CBP, under the Enforce and Protect Act, EAPA.
What's that about exactly?
Well, EAPA investigations typically look into whether companies might be circumventing anti-dumping or countervailing duties. They question the true country of origin of components used in products exported to the U.S. In this case, it relates to modules exported since January 2021. The company stated they're cooperating fully.
But the outcome is uncertain.
Correct. It's an ongoing process. It represents a definite risk factor you need to keep an eye on, given how important the U.S. market is for them.
Okay. And one last thing. They also made a point about sustainability efforts.
Yes, which is increasingly important for access to global supply chains and finance. They highlighted net zero targets, Scope 1 and 2 emissions by 2030, Scope 3 by 2040.
Any external validation on that?
They mentioned being the first Indian module maker to get Environmental Product Declaration certifications, EPDs, and they received a gold medal rating from EcoVadis for sustainability. So they're building that ESG narrative, #tag outro. So wrapping this up, what we've really seen here is a company leveraging a period of record performance, those strong profits and margins, to fund a truly monumental strategic pivot. Waaree Energies is moving fast, shifting from primarily being a module manufacturer to aiming to be an integrated energy major, covering the whole chain. Wafers, cells, modules, yes, but also BSS, hydrogen, and even downstream power infrastructure like transformers and meters via those acquisitions.
Yeah, the vision is huge, and the potential reward, if they pull it off, is equally massive, especially with that 47,000 crore order book already secured. But as we discussed, it all comes down to execution, doesn't it? Can they convert that order book efficiently? Can they ramp up those huge new BES and hydrogen capacities on time and on budget? And can they navigate those geopolitical risks, like the ongoing EAPA investigation? That's where the real test lies.
Absolutely. Which leads us to maybe a final provocative thought for you to consider. The company, and many others, project that future energy demand in India will be completely reshaped by two massive new consumers: data centers and green hydrogen production facilities. Now, if these drivers really take off at the scale people are talking about, think about that potential 176 GW data center demand in the US by 2035. What does that imply for India? What kind of additional, maybe even unplanned energy infrastructure capacity will India need to build, far beyond the current 280 GW solar target for 2030? And perhaps more importantly, how quickly can a nation possibly mobilize the resources to meet that kind of potentially explosive acceleration in demand? Something to think about.